All right, good evening, or good morning, depending on which part of the world you're located in. Welcome back, everybody. Hopefully, everyone's having a wonderful Monday. Today, we are going to be reviewing or learning for the first time, depends on which level of education you are at. We're going to be covering Fibonacci, mainly speaking, Fibonacci retracement. So, as always, everyone, I like to keep the environment fun-filled, as fun-filled as education can be. So let's keep it casual. Let's have a good time. If you have questions as we go along, feel free to type them at any time. If I don't answer it right away, don't panic. I will go through all of the questions if there are questions at some point or another when I feel that it's a good time to answer them. But to ask the question as soon as you think of it. That way you don't forget it and you're not stressing about it later, wondering what in the world you were going to say. I forget things as well, so I completely understand. Don't feel like you're being rude. You're not interrupting me. That's exactly what I want. If you understand everything that I'm saying and that everything seems to be coming across clear and you don't have anything to ask, then don't feel like you have to force it. You don't have to ask anything either. Let's have a good time. Let's get some good information out there and add some more powerful trading tools to our arsenal. So without further ado, we're going to start off with our disclaimer as we always do. I'll read through the first one, then the next few thereafter I'll leave on screen for a short period of time, allowing you to read them or screen capture them and read them at a later date. So once again, getting the disclaimers out of the way, and then we'll be on to the good stuff. Here we go, folks. Earn to Trade is provided to you for educational purposes only. Earn to Trade is not a financial services company. Earn to Trade does not accept any liability for loss or damage as a result of reliance on the information contained herein. This includes educational material, price quotes, and charts and analysis. Please be aware of the risks associated with trading the financial markets. Never invest more money than you can risk losing. The risks involved in trading are high and may not be suitable for all investors. Earn to Trade doesn't retain responsibility for any trading losses you might face as a result of using the data shown on its websites or webinars. The data and quotes contained may not be provided by exchanges, but rather by market makers. So prices may be different from exchange prices and may not be accurate to real-time trading prices. Any examples used are not a recommendation to buy or sell or solicitation to buy or sell futures, options, bonds, or binaries or securities of any kind. The information and strategies and techniques discussed herein are the property of Earn to Trade LLC. They may not be shared or distributed to any other party without the express written consent of Earn to Trade LLC. Any trademarks or copyrights referenced other than Earn to Trade are the property of the respective holders and not Earn to Trade LLC. All right, moving on to the next one. Take a moment to go ahead and quickly read through it or screen capture it and read it later at your own pace. All right, moving along. Same scenario, everyone. Please take a moment to read through or screen capture and read at a later date. And on to another one for us. And finally, our very last one, and then on to the fun things. Alrighty. Actually, why don't we throw that on one more time? Okay, so like I said at the beginning, guys, if you are joining in just a little bit late, today we are going to be covering Fibonacci retracement. We're going to be covering the Fibonacci retracement tool, how it can be used, how it can potentially benefit you in your trading each and every day, and just its many uses. If you decide that it is something for you, then congratulations, you just gained something to your arsenal. If you decide that you don't like trading with Fibonacci, then guess what? You don't have to. So it can only help, can't hurt, right? So anywho, moving on, we're going to start talking about, before we go a lot deeper here, I'll switch the chart screen, but we're going to talk about initially what Fibonacci is. You know, I keep saying this big long word. If you're unfamiliar with it, Fibonacci, it's kind of a funny sounding word, and I keep saying the Fibonacci retracement tool. Now, last week we covered the trading tools that are available to you on the platform in terms of just direct drawing tools. We didn't go over every single indicator available. However, one of those most beautiful drawing tools happens to be the Fibonacci retracement tool. So Fibonacci retracement in and of itself, it's a popular trading tool, if you don't know what it is, among technical analysis traders, which is what we're looking to cover here, obviously. And it's based on the key numbers identified by the mathematician Leonardo Fibonacci, hence the name Fibonacci retracement or the Fibonacci sequence. The Fibonacci sequence is a series of numbers where I'll just essentially, it's the last two numbers added to themselves to create the third number. So in sequence, it would sound 0, 1, 1, 2, 3, 5, 8, 13, then 21, then 34, then 55, 89, 144, etc., etc. So essentially, we arrive at this sequence of numbers by just simply adding the two previous numbers to come up with the third one. We're just going to briefly cover what this sequence is because it is the sequence that the ratios are derived from, or pi in and of itself. But in technical analysis, Fibonacci retracement is just simply created by taking two extreme points. Now, this is when we're using that retracement tool, usually a major peak and a trough, as I'm going to show you here shortly, on some type of a chart, and dividing the vertical distance by the key Fibonacci ratios of 23.6%, of course, 38.2%, 50%, 61.8%, and 100%. These are the main ratios that traders generally use when they're talking about Fibonacci retracement. However, there are other levels that traders might use as well, but we're going to talk about these before we get a little bit too deep down the rabbit hole. And remember, like I said, if anything I say comes off as confusing and you feel I can do a better job clarifying, please don't hesitate to ask or you know, say, hey, can you slow down, or can you let me know this? Sometimes I bounce around. It's just the way my brain fires, and I know that everyone's brain doesn't work the same way. But I do want to do my very best to try to help you guys get this information as locked as possible. But once those levels are identified, the ones that we were mentioning, the 23.6, the 38.2, the 50, the 61.8, and the 100, horizontal lines are then generally drawn by the indicator in and of itself if you're not calculating the math yourself, which hopefully you aren't, because just about every single trading platform out there known to man will have some type of pre-drawn Fibonacci levels for you, some type of tool that does it for you, does the math for you, and draws the levels for you. But the horizontal lines that it does draw are to identify possible areas of support or resistance. So you already, if you're new to Fibonacci, you already understand where we're getting ready to go with this. This is a tool that allows us to identify possible future areas of support or resistance based on key levels of retracement around the Fibonacci sequence. But before we can understand, you know, why these ratios were chosen, as in the 23.6, the 38.2, the 50%, the 61.8, and the 100%, we really want to have a better understanding of the Fibonacci number series as we just mentioned. The 0, the 1, the 2, the 3, the 5, the 8, the 13, so on and so forth. I'm not going to go through them all entirely again, obviously. You guys can do the common math there. It's just simply a sum of the two preceding numbers in order to end up with the third. Now, the sequence does continue infinitely, and one of the remarkable characteristics of this numerical sequence is that each number is approximately 1.618 times greater than the preceding number. This common relationship between every number in the series is the foundation of the common ratios used in the retracement studies. Now, one of those ratios in particular is referred to as the golden ratio, and that is the 61.8% retracement. The 61.8% retracement is the most commonly and most generally respected Fibonacci retracement level of them all, which is why it's referred to as the golden ratio or the golden mean. Now, this is found by dividing one number in the series by the number that follows it. So, for example, 21 divided by 34, as we already know, those are in the numbers as we were talking about, equals 61.76, and 55 divided by 89 equals 61.79, right? So we're coming up with those 0.618. The 38.2% ratio is found by dividing one number in the series by the number that is found two places to the right. For example, 55 divided by 144 equals 38.19. So there's our 38.2, obviously, moving the 19 to the 2. The 23.6, and if those of you that are clever already know what's about to go, so if the 38.2 was found by dividing one number in the series with the number that is two points to the right, I'm sorry, found two places to the right, I shouldn't say points, found two places to the right in the sequence, then the 23.6 is found by dividing one number in the series by the number that is three places to the right. For example, taking 8 in the sequence and dividing it by 34. Now remember, the sequence goes 0, 1, 1, 2, 3, 5, 8, 3, 21, 34. So the 23.6, when you take that 8 and you divide it by the 34, that 34 represents the number that is three places to the right. And that ends up with the 0.2352. All right? So you guys starting to catch on to where this is coming from and how they're all derived. Now, for reasons that are unclear, these ratios do play an important role in the market. Now, this is the Fibonacci retracement tool in and of itself has been used widely by traders for a very long time, and there is no direct answer as to why it does seem to work so well and why it is so popular. Some people theorize that the Fibonacci retracement tool happens to be more or less another self-fulfilling technical analysis prophecy, in the sense that because everyone expects the market to potentially turn at this location, they then make it turn at that location because they start selling or buying in expectation of those particular moves to happen, and then in turn the market does do those things. So even though the exact reason why Fibonacci works is, kind of more of a mystery or generalized theory than an exact, that does bother some people at its core, it is undeniable the value that Fibonacci and how frequently Fibonacci is actually respected, and we do find levels around these key areas. It's a very, very powerful trading tool that I have used countless times in my own personal trading. It's extremely easy to understand. It's extremely, in terms of using, you don't even have to understand all the math behind it. You just have to understand how to draw it and which levels you want to pay the most attention to, and just simply wait for the action, as you'll see. So if all of the math that I was already talking about kind of confused you a little bit, and you just want to say, oh, this might be, I promise you it's not as scary as it sounds. But anywho, so once again, the levels, these retracement levels, the 23.6, the 38.2, the 50, the 61.8, these areas, we want to think of them as just potential areas of support or resistance, and then we're generally just looking for the market to respond around those areas and either confirm our suspicions, or potentially one of these areas overlaps and already, maybe it overlaps a 200-day moving average, maybe it overlaps a daily high, maybe it overlaps, there's a number of things that could overlap that could cause the strength expected to occur at this level, or the reliability of this particular level, to be all the stronger. Even though 50%, for example, isn't a Fibonacci ratio, and neither is 78.6%. Those are two other numbers that traders do generally like to use. Traders like to use the 50% retracement level just for the tendency of any particular asset to continue in a certain direction once it completes a 50% retracement. And we could accredit that once again back to that psychological trading, the expectation that people are getting scared that it's already retraced about half, and we like round numbers. So we could do that, accredit that 50% to something similar to a psychological level, what have you. But it is important to note that 50%, even though it's not a Fibonacci ratio in 78.6, 78.6 is another level that traders do like to implement as well. But going on, what we're going to be doing today, I kind of dived right into things. I'm going to go through the charts and I'm going to draw off multiple different, these are live charts at the moment. I'm going to draw off, use the Fibonacci retracement tool and draw off areas in the market and see how they would have hypothetically performed. And we'll talk about how we could have traded them, how we could have possibly put some entries in, and maybe how we could actually have gotten out of it, and possibly use this information to help us gain some profits or keep us alert in the future. As we continue to trade, we want to stay alert to all the things that are available to us. Knowing something is never going to hurt us. It's only going to afford us extra opportunities should those things arrive. We don't want to force a situation in which it doesn't seem like the market is abiding by any of those levels, of course, but in the situation that we do draw it out and it does seem like the market is adhering to it perfectly, we could have just given ourselves a huge leg up on the competition and given ourselves an insight into the market and keep us one step ahead. And when we're one step ahead of the market, that equals profit for us. But anywho, moving onward. So the Fibonacci, there are more uses of the Fibonacci sequence itself in trading, but the Fibonacci retracement is the most widely used of all the Fibonacci trading tools, which is why I'm going to be generally focusing on that. It's partially due to its relative simplicity, like I was talking about. We're simply drawing from a peak to a trough, from a high to a low, and we're always going from the left to the right, as you'll see here shortly. The beautiful thing about the Fibonacci retracement, like I was saying, is it can be used to identify and confirm support or resistance levels, potentially place stop loss orders, target prices, or even act as a primary mechanism in a counter trend trading strategy. We want to use Fibonacci trading in and of itself as, like I said, as a way to help increase our chances of success, but not directly rely specifically on Fibonacci itself. It's as with all forms of trading, things combined with each other for multiple layers of confirmation generally give us the best results without over complicating things. That is, of course, we don't want to add so many things that it becomes unrealistic that we're even going to see some type of trade set up for us. But it is, using something like MACD or some type of momentum indicator in cahoots with Fibonacci is always going to be helpful, because at the end of the day, when we're using Fibonacci, we are looking to place a position based on some type of expected reversal. Although we might be trading with the overall trend, the current short-term trend we are essentially going against that if we are getting in while it is still temporarily pulling down. But without further ado, I'm going to go ahead and talk about how we can draw Fibonacci on the charts, even though we did cover this just briefly or last week. I'm going to draw Fibonacci on the charts, and we're going to see how it would have potentially performed. So we're looking at today's data. As we can see, it's currently still moving. It's Monday. It's Monday the 23rd, 2018. We're going to back up just a little bit. I see a nice little bearish move here where we had a little bit of a hiccup. And then we kind of went on down, found a plummet. So let's just go ahead and see how we would do this with Fibonacci. So we're going to pretend that it's at this point here that we're going to use, that will have applied Fibonacci. That will have applied Fibonacci because of the strong retracement, the strong wick, and the support seemingly being showed here, along with the bullish momentum that came thereafter. So how are we going to do it? First, we're going to click on our little pen on the bottom left. Remember, bottom left, in between the plus and between the chart sign. We're going to click on the pen. It's going to create a bunch of icons up here in the top left. This is our drawing tools like we covered last week. Then we're going to go over here and click on the 3 horizontal lines. Now, when we do that, we're going to be given all kinds of crazy stuff that pops up. We're going to be given a value column on the left where we can adjust these values. Now, I'm not going to be adjusting these values because these are the main values that I want to be focusing on, and these are the most widely used Fibonacci retracement values. And so naturally, you'll see it starts with 0, then we have our 38.2%, then we have our 50%, then we have our 61.8, which is our golden zone, and then we have our 100%. Now, we can change the color of all of these levels. If I want to change the color, I'm simply going to click on the box, and I'm going to set the color that way. Now, I'm not going to do that. I'm just going to leave them all one color. We can also change the width here as well. It's just some cool, we can also add levels. It's just a cool little customizable feature that we have on our platform. Your Fibonacci retracement, if you're not using our platform, may not have this, or maybe it does, and it might be slightly different. But this is just, once again, just letting you know what is available to you if you are trading on our platform. So starting off here, we're going to go ahead and we'll make it, well, this, this little bit of a darker goldenrod color. So we're going to go over here, and remember, like I already said, we always draw from left to right. Price is always moving from left to right. So we are always going to draw from left to right, and we want to go from the high or low. In this case, the market was moving down, so we're going to start at the high and we're going to end at the low. So we're going to go from the left to the right. We're going to go from the top of that move to the bottom of that move. And after we've done that, okay, we're going to see some interesting information here. So by going from the left to the right, identifying with the top of the move to the left and the bottom of the move to the right, we're given the 61.8% here, right? We're given the 50% right below it, 38.2% just below that, and then way down here we have 0. Now remember, just think of these percentages as percentages of retracement from ground zero. Ground zero is going to be 100%. That's going to be where we started from, right? Because if price were to move all the way back to this point, that would represent a 100% retracement back to ground zero. It's gone 100% of the way back to where we started. So if it works its way up to 61.8, that means it has worked its way from 0 to 61.8% back to 100, right? 50% means it's gone exactly halfway back to 100. 38.2, just under, obviously. So pretty simple concept there. But what do we see immediately off the bat? Well, right away, right here, turn this level a little bit white, it looks like that 61.8% level was actually used as a level before we would have actually been able to use that information from drawing from the base. Because remember, if we didn't draw till we saw it down here, we wouldn't have actually seen that as a level, not a 61.8 that is, until we were able to draw from down here. Now, let's say that we drew from this point here. All right, we'll make this one purple. Same thing, and we're going to say we drew right down here to see if we got anything out of that. Now, it looks like we were creating that 61.2. I'm sorry, the 61.8 is very close to what would have been the 38.2 in that situation. A little bit far off, so not a great example. So we're going to go ahead and get rid of that for now. But it does look like we were creeping towards a fib level, even though it wasn't the 61.8. If we went from this measured the short move here, where we just went from the same high to this base, pretending we didn't go all the way down here. But nonetheless, going back to what I was talking about. So going from the high to the low, we're given some levels. We have our 38.2 down here. All right, and just following that across, you'll notice a few areas where it functioned as an area of support when the market was on top of it, and then after it started functioning as an area of resistance. So here was our support after we broke through it, and before that it was resistance still. So we've got some key pivotal action forming around that 38.2, where you can see the vast majority of these candles weren't trading through it, but instead bouncing off of it. We had one candle here that went through it, and we had another candle that broke back below, but every other candle along the way used it as a bouncing point, either to stay above it or to stay below it. Only 2 candles out of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 or so candles actually, only 2 out of 13 actually traveled through that. All the rest used it as some rejection point. So that's kind of interesting to see that 38.2 was functioning, and this is information we could have used in real time because, once again, we drew over at this point here. So we would have had all these levels drawn for us at this point, which means anything beyond this vertical line that I've just drawn, anything going this way would actually be applicable by those pre-drawn Fibonacci levels. So we've got 50% just above that, and what did we have happen at the 50%? Well, what do you know? 50% actually represented when we did break through the 38.2, it was the next rejection point. The market was unable to actually get through that 50%. As we can see, this big bullish candle pushed its way up, and we rejected, came back down, found a little bit of support on that 38.2, and then we found a little bit more resistance on the 38.2 over here as the market kind of meandered sideways and tuckered out. But it is for our very first example, and once again, I didn't find these ahead of time. I'm going to be going through these live to keep it as real as possible with you. So this isn't a trick. It's not a gimmick. We're going to see exactly how it would have performed: good, bad, great, indifferent, and we're gonna, I'll let you guys generate your own views on the, Fibonacci retracement tool. It is a very, very wonderful, wonderful tool. Very, very important to understand how to use. For how simple it is to use, it can create some very easy trading entry points and potential exit points. So we're going to move backwards a little bit, and we're going to find some more clear-cut moves here, and we're going to see what we can find of them, or what we can make of them. And here's a very clear-cut one, and so is this. So we'll start off here, and we're going to measure the same thing. We're going to go from the left to the right, and we're going to measure the retracement of this big bearish move, where we went from here to here. Zoom in a little bit. Well, I'll just keep it like that. And we're going to see what levels happen. And before I even draw any of this, let's see if this happens to be right about that 50 or 61.8 level. So here we go. Starting from the top of the move in this case, because the market's falling, going from the left to the right, just dragging it over. Okay, and what do you know? Look at that 61.8. It might be a little bit hard to see. This level right here, I'll draw it off in white for you guys. All right, that big white line that I drew, you can't see it because the 61.8 it's the writing is inside our candles right now. It's right there. But that is the 61.8% retracement to this bearish move. And that is exactly where the market worked its way back up to and became heavily stuck underneath. Very strong resistance point, lots of rejection being shown here. And had we been paying attention to the market this time and noticed the substantial resistance and also said, hey, not only is it an area of resistance in the market that had been used previously, it also happens to be our 61.8% Fibonacci retracement level, which we refer to as the golden ratio for a reason. The most widely respected and generally considered to be the most accurate reversal point in all of Fibonacci retracement percentages, or out of all the Fibonacci retracement percentages. So it's at this point that the market worked its way back up to it and became heavily stuck, unable to successfully pass on through, and we had multiple attempts. Buyers tried to get it through, and we just pinged on off of it, and ultimately it caused a very hard push back to the selling, back to the bearish pressure, and back in the direction of the overall trend. So once again, we actually continued our bearish decline. We continued to fall here, and it was very catchable had we been paying attention to these Fibonacci levels. So that's a great example of how we can use Fibonacci retracement. Now, once again, how are we actually going to use this as an entry? How are we going to actually use the Fibonacci retracement as a tool to actually execute that sell like we would have wanted to do there? Well, there's a number of ways we can do it. I'm going to clean the charts up just a tad. We're going to redraw off that 61.8 level, and we're going to talk about how we could have gotten into this. So after we identified and we drew from the bottom, or I'm sorry, from the top of this move to the right to the bottom of this move. So starting from here and going to here to the bottom of that wick, we're going from the highest point of price to the lowest point of price in a measured move, meaning if we have a clear-cut bearish swing, we're going from the top to the bottom. Or if we had a clear-cut bullish swing, we could go from the bottom to the top. But no matter what we do, we're just always going from the left to the right, from the one extreme to the other extreme, and then stretching it to the right outwards so we get our levels to cover across, and then we're going to continue to watch what price does at it. And initially, after drawing it, say we drew it right down here at this lowest point ever, we would have been given a 38.2 right here, and that 38.2 was actually used. The initial time that the first time that the market actually worked its way up to the 38.2, that was the first time the market actually showed some type of resistance after gaining a little bit of bullish strength off of where we were marking off our 0%, the bottom of the move. We worked our way up here. We found a little bit of resistance here. Okay, quite a few times. Now we did eventually break through, and as soon as we did, it looks like candles start sitting directly on top of this level and traveling essentially between here and that 61.8 with a little hesitation even on that 50 over there at some point. So you can see how clearly the market is actually adhering to these levels, but it's the 61.8 that I'm going to focus on because that's where we really would have been looking for an entry. 61.8, our favorite level, our most accurate level, and our in many common beliefs, generally the level, the ratio that most traders are only concerned with. Some traders will only trade around that 61.8% level when they're trading with the Fibonacci retracement. They don't bother themselves with the 38.2 or the 50 because it's not as widely respected, which means its accuracy rates are going to dip a bit. But say we were looking at the market, we drew from the 100 from the left and down here to the trough at the right. We're given these levels. We had all this information ahead of time. This isn't post-drawn. This gave us some leading information here. and the market came up. We waited and worked its way up to that 61.8. And as we reach our way to 61.8, this is the first candle that's going to alert me. That little doji right there. You see if I can. Well, we'll just leave it as is. So the first candle that would have alerted me that we're possibly showing some resistance at the 61.8 is this little doji candle that has a long wick underneath it, a small wick on the top end of it, almost no body. This candle seems to be tuckering out. We had a very powerful bullish candle before it, and this candle came along and was unable to successfully push much higher. It did technically go a little bit higher, but it went right to the 61.8 and got stuck. So it's at this point that I'm alerted. So now I'm going to pay attention to the next candle and see what she does. The next candle confirms all of our beliefs. The next candle comes along and just kind of crashes. There's no further high push. It rejects, it touches the 61.8 yet again and rejects quite hard all the way back down to 38.2 where it then bounces and comes back up. So it's at this point that we say, all right, there's something serious going on around the 61.8. Next time we're offered some type of notice some type of rejection around there or offered some type of price around there, we might want to be in. We might want to be entering in for our sell. Now, how would we do it? We would be looking for as close of a possible as price near that 61.8, which happens to be right near that 1.2385 in terms of actual price. So we'd be waiting for price to come back up, and what do you know? Because of the 38.2 bounce, price did work its way back up. We got right back around that level, and we continue to show rejection. We have a little wick on the top of that candle, hardly any moves making it anywhere beyond the 61.8, almost to the dot. It's at this point that we could have looked in to get in for our sell. Now, where am I going to place my stop loss? Well, I'm going to place my stop loss in a location that isn't far beyond that 61.8 because the information that I'm using is I'm using the 61.8 as a possible resistance location, which means anything beyond that means maybe my information is wrong, maybe the market's no longer adhering to it. But point is, the market really, if I am right, there's no reason the market should actually be far beyond that. So I can keep in a very tight stop loss without really much worry. Because if the position is going to hold, there's no reason it should actually be touching there. Or it should be touching, say we want to keep our stop loss right up here at the 3.9. Okay, so give ourselves a nice little tight stop. We use the 3.9. There's no reason, if I was correct, that this should be hitting. So if it hits, we can keep ourselves nice and tight, get out short and easy just in case things go wrong. And we know sometimes they do. We're not going to win at every single position ever, but we want to be we want to manage things correctly, keep our risk low while our reward potential is high. And that's what we see here. We see a lot of rejection going on around that 61.8. Great opportunity to get in where essentially there is no limit on the floor. We could watch this thing fall forever. And realistically, if it ever does go above that 61.8, it's a sign that the market is no longer adhering to it, and then we can get out nice and quick. So we stand to gain a ton with very little risk. So low risk, high reward potential scenario here, in my opinion. So we could have gotten in for a sell right here, set our stop up here. Market never ever even made it back above that 61.8 period. We came up to it quite a few times, rejected quite a few times, and then we just went for the ride. And it's at this point down here that we've made a very nice gain. We can decide, okay, we're noticing some significant support being shown on around that 1.2330 location-ish, 1.2335. We're noticing some support at that location, but the most important thing that I want to pay attention to here is the lack of bearish momentum continuing. As we start to work our way sideways, maybe a little bit of a momentum indicator would help us here as well. But we can see that at this point, the market isn't comfortably falling at any rate. We're kind of working our way sideways. We've got a little bit more a little bit more bullish pressure than bearish at this point, and it looks like the market's trying to recover. We see quite a few candles where the highs are getting higher. So it's somewhere over here that we'd be looking to probably close the position off and take our profits, which would be a substantial gain, working our way from that 1.239 all the way down to that 1.234-ish location. So that's a way that we could use that Fibonacci retracement tool to get in and to get out just using common price action. So the idea at the end of the day is it comes back to however you want to gauge the momentum, however you want to gauge the strength or the rejection. There's a lot of different ways to do it. You can pay attention to just standard Japanese candlestick patterns. You can go ahead and use a momentum indicator. You can use, like I said, MACD. There's a lot of things that you can use. But however you feel comfortable, adding confirmation to the fact that that level, that 61.8 level, is in fact being respected. The market is in fact using it as a particular area of resistance or support. Whatever it is, we're looking for price to reach that area and then begin to actively function around it as we would expect, meaning it is rejecting off of it. Now, you can gauge that, like I said, with any kind of indicator or just simply old school price action, paying attention to what the candlesticks are doing. So let's go ahead and go backwards a little bit more and see if we can find some more Fibonacci. All right, so if I were to draw, just out of curiosity, I'm going to draw from the top of this move right here down to the bottom, and we're going to see if this happens to be like the 38.2, where the market actually pinged off of on the second bearish wave. So that wasn't supposed to happen. It kind of freaked out. Hold on a second here. Let's see if we can adjust that. Alrighty. So if we work our way to the top of that move, to the bottom of that move, just going from the left to the right, we did have one little nice hiccup here. It actually does look like that 38.2 it was exactly where the market got stuck underneath. So once again, we see a beautiful example of Fibonacci giving us, or we see a beautiful example of the market respecting one of these key Fibonacci ratios. It's not the 61.8. We didn't even make it there. The market came up. It retraced to 38.2%. 38.2% of the move going from the top to the bottom. And it's moving from the left to the right. And we worked our way up to that 38.2. We actually pinged up to the 50 on this one spike, but the candle was unable to close up there. And the market continuously, for the entire time here, we're talking for a period of many, many hours, the market traded directly underneath that 38.2 and was unable to get back above it. So great example of Fibonacci yet again. It is with this information, there's a number of things we can do from it. When we start identifying that the market is rejecting around this level, it's the same as identifying any other level of support or resistance. We can either use it as a location to enter in on. If we don't feel comfortable with it, we can wait for the market to finally break through it. And if it does, we can use it as a platform to launch us up if we believe the pressure, the market stayed under this level long enough, and we believe the pressure was strong enough that we can actually use it in anticipation of a breakout like we had talked about a few weeks back. All of that built up pressure should propel the market farther in the direction of the break once it does go through in theory. There's a lot of different things we can do, but once again, great example of the 38.2 level, 38.2 ratio holding wonderfully for us, creating other possible entry points. Now, the market was rather dead here, mostly moving sideways, not a whole lot of momentum, but it is still worth mentioning. So let's go backwards, and we will see what else we can find. So let's see. Let's use this right here. We have a very clear-cut bearish move. We have a base right here where the market began finding support. And if we were watching this in real time, it would have been very easy to draw from the high here to the left, or I'm sorry, to the right. I don't know why I'm getting my lefts and rights confused. It would have been very easy to draw from the high to the low there and just draw it out sideways. I actually drew that a little bit off. There we go. Hold on. Close enough. Okay, very easy to draw from the left to the right. In this situation, we have a very identifiable high, and then we have a very identifiable low. And what did that do? It gave us another clear indication of Fibonacci working. We have an example here where, once again, the market hit its first area of potential resistance, and that first area just held. We never even made it back towards that 61.8 for quite some time. We hit a situation where that 38.2 held, and we worked our way up to it, and resistance was shown over and over and over, and once again the market went ahead and plummeted on off. So this is a situation in which we could have potentially looked for some type of a short opportunity here if we felt comfortable using the 38.2 as our base platform, noticing some type of tuckering out in this bullish retracement that was going on, and after this final kiss here, we could have been looking to get in and ride some of this wave down. Not an ideal situation because it really didn't have that strong of a retracement and there wasn't a whole lot of test at that level, but it is indisputable that that was a beautiful 38.2 rejection nonetheless. So we're going to keep going backwards, keep seeing what we find. And remember, guys, if you have any questions or if anything is confusing you, definitely ask. But it should be kind of hopefully, I should be hopefully shedding some light on what the Fibonacci sequence is, where these ratios are derived from, how Fibonacci retracement tool is drawn correctly, and then how it can be implemented. That was the goal of the webinar to begin with, and I feel like we're actually starting to come full circle on that with these examples. So hopefully, after one or two more, you guys have the picture under control. So let's see what we can find here. See if maybe we can find a nice bullish one as well. I want to find a big bullish move. So much bearish momentum in the market. We'll use this one and see what happens. Okay, we'll use this one. Not the biggest, but let's see if we can. Every example we've used thus far, without fail, has provided us a very valuable piece of information. So what do we see here? All right. So I've gone from the left to the right, as always, but in this situation, we're going from the bottom to the top because the market was moving upwards. We started at the lowest point, and we ended at the highest point. And it gave us 38.2 beautifulness yet again. It gave us a beautiful show of this 38.2% retracement level, functioning as, once again, another potential area of support resistance. So by doing this, all of the information beyond here, everything to the right of this vertical line would have been available to us at the time that it was occurring, which means we could use this information to possibly trade. Now, this isn't the largest bullish move in the world, so we're not going to expect the largest, and it was also during an overall bearish downtrend. So this is a situation where we really wouldn't be so heavy into the buying, but if we were just looking to scalp a little bit out of the market, it definitely was possible here, based on the drawing from the left to the right, top to the bottom, I'm sorry, from the bottom to the top, and drawing the lines out to the right. We noticed that right around 1.2325, where the 38.2% is, we had a very solid show of support around this location. Our very first approach, it looks like the market got a little bit scared over here, but then when we actually did touch it, we had a nice little bullish pop, came back down to it, sat directly on it, never went below it, and then we had a little bit of bullish momentum for about an hour or so, working our way up off of it. Nothing serious. Then we kind of came back down to it, dipped a little bit below it, and then yet bounced again. Market was kind of meandering mostly sideways here, but we can still see the signs of that 38.2 affecting the market. And that's where the value is. That's the information I'm trying to get across here. Every single example was not pre-planned, and every single one thus far has had beautiful Fibonacci respect being shown, even in rough examples, even in a rough measurement. This is a very small bullish move that I'd use Fibonacci retracement tool on. Generally speaking, the larger and more consistent of the move that you're measuring, the more consistent and reliable the results and the expectation of those retracement levels functioning as a potential support or resistance will be. So onward we go. We'll see if we can find yet another beautiful example before we, kind of push into the questions and or close it off if everyone's got it under control. I really do want to try to find some more bullish examples, but the market is just so heavily bearish with the points that we're analyzing right now. Oh, here we go. I like this one. All right, hopefully this provides us a nice example. It looks like if it does, it will be somewhere around that 38.2 yet again. But here we go. We're going from the bottom, the lowest point in the move, to the right, going to the highest point in the move, and we're going to draw it off to the right. All right. Now, by doing this, we're going to mark off where our 38.2 is. We're going to see what happens here. Now, despite this not being a very usable area, we can still see, once again, a presence for the market to reverse after it does pull back. At the first Fibonacci level it would approach naturally, the first widely respected Fibonacci level it would approach would be the 38.2. And right here you can see this big bearish candle and a little bit of the bullish one right after it. Price got very, very close to that 38.2 and immediately rejected right off of it. And the next time that we came down was over here. We actually kissed it exactly, and then it continued to work our way off of it and then found support even more to the right over here. So this is another example of the market retracing down and then bouncing directly off of that 38.2. And this is all information that we would have had ahead of time and would have been able to use to possibly execute some trades and scalp the market. So I'm going to continue moving the examples. Hopefully it's clicking. Remember, if you have any questions at all, definitely feel free to ask. Let's see. There's a nice little bullish swing. Let's see what we've got on this one. We've got a very powerful one over here, and we have one right here to the left of it. We'll check them both out and see what we've got. Now remember, Fibonacci isn't going to work every single time, as in nothing in trading works every single time. But thus far, every single example that we've shown, every single move that we've measured actually had potential for profitable positions, every single one. So at this point, it does look like Fibonacci is the golden tool. But regardless, just be aware that just like any other form of trading, it isn't going to work every single time. But what's going to make it so valuable to us is the fact that we don't have to just use it. We can use it in cahoots with other things. We're not going to guarantee that we're into a position just because we've drawn it and we have those levels predetermined. We're going to watch how the market responds around those levels, and it's the levels that the market seems to respond to that we would then use as an area to enter into, just like any other form of trading. But let's go ahead and measure this one. We're going to go from the bottom over here, the top over here. We're going to draw it out. Now this is a very small area. It's a very small area, but once again, we can already see. Zoom that in a little bit. We can already see in this area right here, folks, that we did have some action around those magical levels. So we would have had the information given to us at this point, and anything to the right would have been possibly traded, meaning anything going this way. Anything going to the right would have been potential entry points. And what did we have here? This one we had an example of a 50 fib bounce. 50 fib is the level, the 50% retracement is the location in which the market decided to reverse. And now once again, we can base that 50% not so much on Fibonacci, but it could just simply be due to the psychological roundness of the 50, meaning halfway there, just like we like to stop when we're pumping gas at 200. It's a situation in which that self-fulfilling prophecy notion kind of overtakes the market, but because of it, we can actually take advantage of it. So the market came down, and we had a little bit of support on our first attempt here, a little bit of trouble getting through on the 38.2. Now this would have been our pay attention candle, and it would have been the, okay, we're going to wait one more and see what happens. Well, the next candle came along and actually plummeted through and went down to that 50. So it's at this point that we say, okay, well, look, we showed respect to the 50 now. So let's go ahead and wait another candle and see what happens. Now the next candle is where we start to get excited. This candle stayed on top of it. It's at this point that we have now seen two candles comfortably hold on top of this level, and this one's actually entering a little bit bullish. So it's at this point right here that we can make the decision to quickly say, all right, we're going to go ahead and execute a buy, and say we got the worst possible price here. This would have gotten us in somewhere around the 1.2233 or so. Would have been somewhere around that 1.2233. So if we're in somewhere around that 1.2233 in for the buy, we would have been looking to set our stop loss, obviously just below the 50, or if we wanted to get a little bit more loose, we could go just below the 61.8. But regardless, we would have been in a situation here where we could just mentally say, this is where we're going to be looking to close our position, assuming the market starts closing and breaking below these levels. Now, what happened after this? The market never actually closed below these levels. Had we set a stop loss that was just predetermined and we just walked away from the computer, this big spike over here could have potentially triggered our stop loss as the market went right back up. But if we were just trading, paying attention to the market, trading in person, this little bit of volatility, we could have overcame it just by realizing that none of these candles actually spent any substantial amount of time below the 50, and we actually never closed below, meaning we never had a true breakout. So because of that, it is very, very possible that we could have been in here for our buy and held on to it and actually gained quite a lot here when the market rocketed upwards. So that's a great example of that 50 fib functioning as an area. It's our first example of the 50 fib functioning as an area, but it's an area nonetheless, and that's how we can trade it. Now, it's this big swing that makes it a little bit more questionable. Like I said, it is possible we would have been stopped out, but in this situation, it is still another low risk, high reward situation. Even if it stopped us out, okay, we had a small loss there, but all the other gains that Fib has given us on all the other examples would have already outweighed that, which is beautiful. So no matter how you look at that situation, if you count it as a loss or you count it as a win, we'd still be coming out ahead overall regardless. Now let's go ahead and take that. Let's take this off. And let's measure, take a look at this bullish move to the right. This will probably be our final one here, see if we get anything out of this. This is a bit of a weird one. This is a bit of a weird one. Obviously, we probably had some type of news coming on at this point in time. It's 8:45, just after the cash open. We're in a situation here where the market got very, very volatile, as it generally does around this time. Probably had some news hit the market. Market swung real hard down during this low swing, and our high swing would have been right here. So if we follow this just to the right, now, granted, we're obviously not going to go too far to the right, but what a beautiful look at this, folks. So everything past this point here would have been available information to us. Or if you waited to here to draw it, everything past that point would have been available, meaning everything over here and everything over here. All the information drawn on these lines. Here's our 38.1. I drew it actually a little bit low. Here's our 50. I'm hand drawing these, so they might not be perfectly straight. I apologize. But a beautiful example of the market pinging hard off of that 38.2 and returning to the bullish momentum that it already had created. Beautiful, beautiful, beautiful. There's a lot of things going on here. Looks like we have a bit of a tightening wedge formation, almost a flag formation as well, based with the big bullish move being the flagpole and then the tightening wedge up here being the flag before we broke out. But we're going to focus in on that 38.2 bounce. So we were given our information. We drew our Fibonacci retracement tool like we've been talking about over and over again. The market came down, hit that 38.2, pinged off of it beautifully, and went for one hell of a ride. Great opportunity here to possibly get in for some profit if we were paying attention. We were quick to act on that. Now, if we're new to Fibonacci retracement, this might not be the location where we could have actually realistically pulled a lot of profit because we probably would have been too afraid to, but it sure as anything would not have hurt us. And if it can't hurt us, it might help us. So another beautiful example of those levels working wonderfully. Like I said, folks, as you can see already, the Fibonacci retracement tool, if it doesn't have you excited, if it's new to you, you should be getting excited. It is a very easy to use tool, as you can see now. Very easy to use tool with a lot of potential, a whole lot of potential. Other than that, folks, if you have any and all questions, definitely now is the time to ask them. I feel that everything has been, I've tried to make it as straightforward as possible, but you know, I'm not, I know that I'm not always perfect when I'm speaking, and sometimes I get jumbled, and sometimes I speak a little bit quick, and if I have, I do apologize. But if you have any questions, definitely feel free to ask them. Just a recap, essentially what we've learned today is we've learned what the Fibonacci sequence is, how it applies to Fibonacci retracement in and of itself. We've talked about how to actually use the Fibonacci retracement tool on our own platform, which is probably very similar to any other platform you use to draw it, apply it to our charts, how to draw it correctly. We've talked about using it in a bullish situation as well as a bearish situation. We've talked about how to enter into a position and how we might want to exit a position just based on the lack of momentum thereafter, and when it's just, you know, it seems like an intelligent idea to get out. It is using the Fibonacci retracement tool is going to fall under discretionary trading, of course, but it is something that we feel can be absolutely invaluable to you as a trader, just to simply add to your arsenal. I'm not saying the only type of trading that you have to do forever is Fibonacci retracement trading, but boy, oh boy, it will provide opportunities after opportunities after opportunities. I do appreciate everyone joining me for another wonderful webinar. Thank you very much, everybody. It's always a pleasure to feel like I'm giving you guys something, to see you guys grow, to see you guys continue to prosper and continue to trade successfully, or to help you become more successful, or to help you become successful in general. But I do look forward to seeing you all back here with me when we do our daily recaps or in our next webinar. In the meantime, everybody, it has been a pleasure as always. My name is Chris, as you guys should know by now, and if you don't, then once again, my name is Chris. I am a mentor and trader here at Earn to Trade. Thank you again for joining me. I appreciate everything that you guys do for us here. I will see you all soon, very, very soon, folks, as we do the recap later on today as well. So good luck, happy trading, get using that Fibonacci retracement tool, and feel free to share some of your success stories with me thereafter. Thank you, everyone. See you soon.